Some people don't want debt. The power of debt, as we've talked about, it is true. So, 3.5 years, didn't even own an agency, and now he's 2 million EBITDA. And you guys know better than I do with the valuation work, what he could sell his business for today.
Welcome to Business Refocused, a podcast about the people, decisions, and strategies behind building a successful business. Each week, we talk with leaders and operators about what they're learning, what's working, and the challenges that come with growth. I'm Lindsay Sexton, and I'm happy to introduce you to my co-host, who just so happens to be my mom, Carey Wallace. Let's get into it. Hey, Mom, how's it going?
I'm having a good day, Linz. I hope you're having a good day today.
I am. We got some crazy summer storms happening, though. I feel like even though I'm up in Ohio now for the summer, like even up here, I'm having crazy storms. And I think down there you are as well.
We are. I will tell you, I was on our team call this morning and it got like super dark in the room. And I'm thinking, what in the world? And I looked out and I literally couldn't even see. I couldn't see for hardly anything out the window, which is crazy. But now it's sunny skies and beautiful. So welcome to Charleston, you know?
I know. I swear those storms just target when we're about to jump on our podcast. It's like, oh, they see it in our calendar and they're like, yep, that's the moment.
That's funny. Well, we oftentimes get to have people on the podcast that we know, we like, we trust, they're our friends, but we don't get
and
to
this
spend...
isn't that. No, I'm kidding.
Like, oh, that's hilarious. But what I was going to say was we don't often get to spend time together with them as much as we'd like to because, you know, we interview people all around. But this week we get to have someone that we actually got to spend some time with last week. So Covington, welcome to the podcast. You're with Live Oak Bank and we were together at an event last week. So it's great to see you again.
Great to see you guys. Thanks for having me on.
Yeah. Don't listen to Lindsay. That was not where I was headed with that.
Yeah.
I just think it's funny because whenever I'm going to an event that I think you might be at, like I'll always shoot you a text and it makes my day. It makes like the whole event better when you and Ryan are also going to be there because you're just fun folks to hang out with.
Oh, well, I appreciate
feel like we
that.
have a lot of common clients, so it makes it easy.
Yeah, exactly.
Yeah, and they understand what we're talking about.
Yeah,
like some people don't actually understand our language. So it's kind of nice to hang out and have breakfast with people that speak our language. So I love it.
Mm-hmm.
Carey, I remember you had one session when I first met you, and you were just talking about like what separates independent agencies from other industries. And I was like, recurring revenue. And you're like, dang. And I was like, yeah, I get it. But no, I appreciate that. But I love always seeing you guys at the shows, and I do the same thing. I'm always looking to see if you guys are going to be there, but it was fun hanging out in person last week.
Yeah, definitely. So today, I think we're definitely going to talk a bit about acquisitions. We're going to talk about debt, and that's a huge topic that we've been talking about with lots of different agencies. I was actually just talking with an agency yesterday about their growth plans and how are you going to grow? You're going to grow organically, you're going to grow by acquisition. And if you grow organically, there's all these different ways. Like, what is your growth plan? A lot of agencies right now are choosing acquisitions in order to grow. And Covington, you guys play a big role in that growth by acquisition, portion of how you do it. So share with us a little bit about maybe a couple, don't name any, I'm not asking you like name any names but what have you guys been up to lately? How have you been helping agencies through this process?
Absolutely. So yeah, I would say 80% of my day-to-day is acquisitions, whether it's a first-time buyer or it's existing agency owner expanding through acquisition. And then, at Live Oak, we've been lending to independent agencies since 2014, I believe. And really any capital they need is what we're doing. So we're also doing commercial real estate, like if they want to buy the office where they lease. We're doing working capital, if they want to do renovations to their office or if they need a buffer when they hire a producer. And then a lot of perpetuation as well, or partner buyouts, partner buy-ins, really all of it. But you're right. I mean, the bulk of it is acquisitions. And I think most of the phone calls I get are, even if an agency is successful in growing organically and they're growing 10 or 15% a year, which is really solid, they kind of want to, take that to the next level. And how they do that is looking at acquisitions, because one acquisition, you can grow 50, 75, 100% at one time. And so, yeah, I mean, I think that, it's important to have the underlying organic growth, but these acquisitions can definitely be meaningful. I'm also a big believer in there's good debt and there's bad debt. And I think that, bad debt, different definitions for all of it. But to me is, bad debt is something that takes money out of your pocket, and good debt is something you can take on and still have cash flow and put money in your pocket. And so, having a bunch of car loans and even your primary house, you can look at that different ways. But, with these acquisitions, the bank is going to make sure that when you take on this debt, you're still cash flowing above the debt payments. And so pretty much you're buying cash flow, which then creates wealth and compounds your EBITDA.
Yeah. Most people don't think about debt that way, though. So, and it's funny, debt has a connotation to it that all debt's bad. So tell me a little bit about this, because I think a lot, or maybe explain it as if you're a sixth grader of what that means to buy cash flow. Like, step someone through that process, because the bank, if a bank's going to lend you money for an acquisition, the reality is they're only going to lend it to you if it's going to create a revenue stream, which is what you're describing. And I don't think a lot of people maybe think about it that way. So talk to me about like what the requirements are for a loan to go through and how that does translate to good debt.
Yeah, absolutely. So, the bank looks at it through the debt service coverage ratio. And so when someone comes for a loan, if it's their first time, sometimes I have to explain to them like, hey, this is different than buying a house. Like, I just bought a house in April, they're going to pull your credit score. They're going to tell you what you're pre-approved for. And, so a lot of people are asking for pre-approval letters. And really it's hard to do because it's all based off the business cash flow. And so there is a personal side to it. Like, talking about the red flags we look out for, like, obviously we don't want to see a bankruptcy. We want to have credit score at least 650, we would like to have it above 680. We want to see a bunch of late pays. But so the personal side, there is a part to that, but really the business cash flow is most important. And again, how we're getting to that is the debt service coverage ratio. And the formula of that is the net operating income. We subtract out required officer comp, and then we divide by the total annual debt. And so if you're at a 1-to-1, you're breaking even, and the bank likes to see a 1.25. And so, I think that, talking about people have a bad connotation around the banks is everything that we do is for the buyer's protection. That sometimes I don't think they realize that. If it's at a 0.8 and you're going to be in the red in a negative cash flow position, and the bank's telling you that, then maybe it's not a good deal. Being above the 1.25 does give you the buffer. It gives you the additional EBITDA and cash flow to reinvest in the business, to take as a distribution. But anyways, I could dig into, so I did put together a little case study, and I think this will, kind of talking about the power of debt, as we were talking about, Lindsay.
Yeah.
So I'll just kind of ramble on, but if you got any questions, let me know. But I'll stay away from obviously like names or anything specific.
All right, let's do it.
But Carey, back to your question about how can you buy cash flow, an example of that. So this guy was in the industry beforehand, but he had never owned an agency. He was never an owner. But he knew the industry well, very sharp guy, has his MBA. And he was like, you know what? I'm seeing all these people be so successful running an independent agency and growing through acquisition. He's like, I'm going to try it myself. So he came to Live Oak in early 2023, and he bought his first agency. Because he was a first-time buyer, he had to put 10% down, but he didn't have the liquidity for that, but he found an investor to do that. And so that deal was a $2.4 million purchase price, where he had a little bit of a seller note for protection against attrition. And he bought $680,000 of EBITDA with that deal. Mm-hmm. Now, he was smart because he knows how to do his own due diligence. There's a lot of add backs. Obviously, we're always adding back amortization, interest, depreciation. But then there's other things. If an employee is leaving, we can collect that W-2 and add that back. The officer's salary. The seller's not going to be paid anymore. They were taking a large salary. You can add that back. So that, if you look at the multiple of EBITDA, that was 3.5 times EBITDA to purchase price, which
Huh,
is really good.
nice. Yeah.
And he found that deal off market, which, it's hard to do, but he found it. So if you're just looking at that, so that first deal, so he bought 680,000 of cash flow, and his annual debt payments were 355,000. So right
Oh,
off the bat, he pretty much bought his way into wealth. But anyways, and then to keep going, like this client is very acquisitive. He's always looking for deals. He has a pipeline. And I think because that first one was so successful, he's like, well, I like this. I can keep doing this. So he came back in January of 2024 and bought another agency that had around 480,000 EBITDA. Purchase price was $2 million. So again, really nice price. He structured that with $400,000 seller note to protect against attrition and to have some seller skin in the game. Seller stayed on for a year to help transition all of the clients, which was a little over 4 times EBITDA. Again, really, really nice price. And then it kept going. Came back in middle of 2025. There's a purchase price of $770,000. He purchased around $320,000 EBITDA with that deal. And then the last deal he's done, the fourth one, was earlier this year. He did a $980,000 purchase price with a 50% seller note for several reasons. But so now he is sitting at $2 million in EBITDA, and he got there in just 3 years and 6 months. And
wow.
It's just really impressive. I mean, I'm sure you guys talk to as well, but I've talked to multiple 4th or 5 generation businesses that are 2 million in revenue. And
sure.
And that is okay.
Sure.
Some people don't want debt, but I think it is the power of debt, as we've talked about. It is true. So 3.5 years, didn't even own an agency, and now he's 2 million EBITDA. And you guys know better than I do with evaluation work what he could sell his business for today. So
yeah, no doubt. So you said something really important, though. You said by having this metric that the bank requires you stay above, we're trying to protect the buyer. And many people don't understand that. So if you're at a 0.8, which that means you're going to pay more in loan payments than the actual profitability that you're expecting out of this purchase, you should back away from that. That happens a lot, unfortunately, in an internal sale where it's one generation to another or one partner to another because they don't get advice externally. They're not going to use a bank loan, so they don't have that gut check of will that happen, which makes a lot of those loans have to be renegotiated when someone realizes they don't have the room to reinvest. So believe it or not, Covington, when we talk to agency owners that are going to do an internal and they want to do a owner finance note and they want to do one of the first things I tell them is go get a bank's assessment of this, because if the bank will loan it, you should loan it. You are in essence becoming the bank. And oftentimes that saves some people and some Thanksgiving dinners that can go a little sideways when you can't pay your note, right?
Right.
Yeah.
And so
I always tell people that we don't sit at your Thanksgiving dinner table, right?
Yeah.
Like, I can be the bad guy that says like, hey, no, this isn't going to work in the model, but you're the one who actually has to sit there and renegotiate in a couple years if you still do it. Sorry, I totally cut you off, but
no,
we always say
that. Perpetuation, we're always talking about that. And so to dig into how the bank thinks about that. So in this example I was using, once you have existing EBITDA, like his 4th deal is so much easier than the first deal because the bank is always looking at a combined EBITDA level. And so if you have $500,000 in EBITDA and you're buying $500,000 of EBITDA, we are looking at now you have $1 million in EBITDA. And so when we're working with producers or key employees or a father and son that have to sit together at the Thanksgiving table, one thing that's been really tricky with how the multiples are in this market is when they want to buy 100% at one time, it's really hard to get that deal done. And most of the times this is a dad or a mom who's grown the business for a very long time. And, sometimes they do have to sell at a discount if they want to do it internally. But sometimes even with the discount, it still puts the son or the daughter in a tough spot. And so we like to have those conversations early and often. We actually had a father and son duo come into the office last week that 5 years away from perpetuation, but just wanted to talk about how that's going to
Good.
work. And that just makes my heart happy because it's like, that's exactly what we're looking for. Like, let's sit down, have lunch.
Yeah.
Like, and they're like, oh, we feel like we're behind the game. Like, you guys are so ahead of it. It's like we get the phone
Yeah.
call where it's like, we want to close in 60 days. We haven't thought about this. We don't have a 5-year plan. But anyways, I mean, so another part of it is if you're buying 100% at one time as a first-time buyer, most banks are going to want a 10% down payment. But the products we have for buying a piece of the business, and so if you perpetuate over time, is very competitive, and it's better than if you buy 100% at one time. So like, let's say you have a father-son duo, like who we were talking to a few weeks ago, and maybe you just start with a 20 or 30% purchase. Live Oak has a product where we can do that from 10 to 15-year term, where no money down. And obviously the seller does not have to guarantee that note. So it'd be an individual note to the buyer. So that's been really popular, thinking ahead of like, hey, Dad, like I can't take on all this debt at once. Like, let's create that plan for me to buy some piece by piece over time.
Yeah. I like that. So speaking of things that Live Oak offers, rumor on the street is you guys are the only ones that have what's called an SBA loan. But tell me about, I know there's probably plenty of services and things you offer. What are like some of the main things that Live Oak Bank offers that makes you guys special?
Yeah, absolutely. So we're doing conventional and SBA lending, and there's a lot of differences to those, but it really depends on the borrower. And so, the SBA is a Small Business Administration. That program was created during the Eisenhower times, and it's really meant to be small borrower friendly. And so, some of these businesses, and not just insurance, I mean, this is for any small business industry, it's meant to be small business friendly. You're guaranteed the 10-year term. There's no prepayment penalties. There's no covenants. Once you've owned your business for more than a year, then you don't have to put any cash down. So we can do 100% financing. There's really a lot of positives to it. Now, the biggest difference between conventional and SBA, which turns some people off to the SBA, is, and this was required by the SBA, not the bank, is that when you have more than 25% equity in real estate owned, so primary house, rental property, if we do an SBA loan, we have to take a secondary lien behind the primary mortgage holder. And if there's a HELOC, then we would take a third position. Conventional, you don't have to do that. And I mean, I like to be transparent. I mean, the SBA is also backing the loans that we do. And so it's a little bit easier for approval. So with that said, I mean, if we do a $3 million conventional loan and that loan defaults, we're out $3 million. And there's no backing by the SBA. So with that said, I mean, the conventional loans, we just like to see a stronger profile. So instead of a 680 credit score, maybe let's look at a 700. Also, the EBITDA is really important. And so, it just depends on the buyer profile. And so if we're working with someone who has $100,000 in EBITDA and they're doing a small acquisition and they haven't been doing it for a long time, maybe that's an SBA deal. But if we're working with someone who has $3 to $5 million in revenue, very strong EBITDA, and they're acquisitive and they have, everything put together, we're going to look at that conventionally. We're not going to offer them an SBA loan.
Interesting. So if there's a first-time buyer out there who's just trying to figure out the landscape, right? How do I do this? I've got an agency that wants to sell to me. What are some things that they need to have prepared in order to look like they've got it together and give themselves the best shot at getting the best options from the bank?
Yeah, that's a really good question. I think some of my best advice would just be, relax and know that you don't have to have everything figured out. I mean, that's why the bank is here. So I have a lot of clients who have not done a deal yet, but I've looked at 5 to 10 for them. And so we say all the time, like, use us as a resource. I mean, I love just making the connection. Give me a call. You get a 2025 tax return and a 2026 profit and loss and balance sheet. I'll run the cash flow analysis for you and I'll let you know what I'm seeing. And a lot of people, after, like, I'm fully transparent, I run the cash flow, we set up a Zoom call, we walk through it together, and I'll tell you if it's a good deal or a bad deal. And, that, just earns their trust, and they know that we're looking out for them, which, we are. We want them to be protected. We want them to be in the green, making money day one.
Yeah, man.
But I think, getting prepared for it is just understanding your own agency and the metrics. So knowing your revenue, knowing your EBITDA, knowing your margins. And then if you are going to do your own due diligence of a seller, which we can help with, but if you are going to, just understand that revenue is fantastic, but EBITDA and profit is really what the bank cares about. So, and I'm sure you guys see this all the time, where let's say, for example, first time buyer or an existing agency wants to go buy a business with $1 million in revenue. Well, sometimes I'll see a letter of intent. It's like, well, I'm going to pay $3.5 million for that business doing 1 million in revenue. Well, that looks a lot different if that business is generating $600,000 of profit, or if it's got 20% margins at $200,000, because at $200,000 of profit is never going to be able to cash flow a $3.5 million loan, if that makes sense. So just kind of understanding, digging into the seller's financials and getting to the true profit, which is really more important than the revenue.
So tell me, Covington, when you see people do their own due diligence, because you've mentioned it a couple of times, and I think lots of agencies hear other people are acquiring and they think, I can do this, no big deal. And once you get into it, it's a pretty involved situation, especially if you have one that goes sideways or not exactly the way that you expected it to, then you realize there might be some other questions that I need to ask. So from your perspective, when an agent is doing their own due diligence, what are some common things that get overlooked or missed that they just don't know to ask the question, or they don't know the true impact of what some of those items would be?
Yeah, that's a good question. I think that most people don't understand, and they're not in banking, but like the true cash flow. And I mean, you guys do valuation work, you understand as well. I think the true cash flow and then the add backs are where they get it messed up a little bit. So, and it goes both ways. So sometimes they think it's a bad deal because they're not including add backs that could be there. And so they don't know if they're not going to retain the lease, and they can add back the rent expense. The bank's going to do that. If if an employee is leaving, then we can add that back on the officer salary. And so it's different from, you're very rarely, as you guys know, looking at a 2025 tax return, and then the net income is what they're going to get. Yeah, exactly. And so doing all that, I mean, even for me doing this for 3 years now as on the team is, it's a process, but I do. And then the flip side of that, which is probably more common, is that people are very add back happy, and they probably overestimate the add backs. And just understanding that from the bank's perspective, that is what I'm doing day to day. I'm digging through tax returns and financials. I'm finding what's the true pro forma EBITDA that the buyer will get. And we're very comfortable with that. But the bank is going to want to verify add backs. And so, you see some crazy stuff. I've seen a one-time $25,000 block party, add that back. But it's just, we're always going through the process of getting to the true EBITDA number.
Yeah. So to that end, though, like if someone really wants to position themselves to have the opportunity, that's what we do. Like we want to help agents have as many opportunities in front of them as possible. And when it comes time to making a decision, any financial decision, that they're not pigeonholed in one place or another. So one of those ways is to know their financials inside and out. If you were going to give advice to an agent and say, here are the metrics that you should know cold about your agency, what advice would you give them?
Yeah. I would hope most people know their revenue, which I think is important, top line revenue, but also their net operating income, because that plays into the debt service coverage ratio. I mean, we talked about the formula, but it'd be cool if agency owners can do it themselves. Just take your net operating income and being able to find that by using the correct add backs, subtract out your required officer comp. So what the bank would think you need to take from the business to live your personal life, then divide by the total annual debt. But I think probably the most important one is the net operating margin. And so, which directly ties into the EBITDA. But I mean, you should know where your profit margin is. And I would say typically how our underwriting team looks at it is around 35% is average, 30 to 35%. So, if you take your revenue over your net operating income, then you can figure out where your margin is. And so with that industry standard, if, again, back to the example, if you have $1 million in revenue and you're generating $200,000 of profit, might be some questions asked there of like, okay, I'm below industry standards. Why is that? And looking through your expenses to figure that out. On the flip side of that, we see some businesses at 50 plus. They're just running really skinny. They don't, but they don't have a lot of staff. I mean, this business, people is the most expensive expense.
100%.
But yeah, I think, knowing your margins and then, how to increase those if you need to.
All right. So you said you started with a really easy one. You should know your revenue.
Yeah.
And then we all kind of chuckled. So I'm going to dig down into that one for just a minute. Not all revenue is created equal. Let's just start with there. Tell me what you do with contingency income when it comes to revenue.
That's a great question. So a lot of banks look at this differently. I know some of our competitors and some brokers I work with take a 3-year average. What we do is we take a 25% haircut on that contingency income. So if you had...
For the previous year or the 3-year average?
For the previous year. Yeah. So we are not doing the 3-year average. We have in some cases. The reason I brought that up is we can look at it both ways. Majority of the time, if they have $100,000 in contingency income, we're taking away $25,000 when we analyze that. So we would just make a negative $25,000 adjustment. And I mean, as you guys know, it's because it's not promised. And it used to be 50% haircut. And then thanks to Mike Strackoff back in the day, he got them to go to 25. So that's how we look at it.
Okay. So that's one thing with revenue. The other thing is, what about different kinds of revenue in your book of business that might behave differently? Tell me some things that you might be able to, because it's really easy. If you look at a P&L, there is a line item that says total revenue.
Mm-hmm.
So someone might be like, I know exactly what my revenue is. And you're going to, contingency income is one of those things that it's there's going to be an adjustment there. Tell me about anything else in revenue that might be an adjustment or something to maybe think about a little differently if you're an agency owner.
Yeah, I think, so typically what I see is you look at P&L and it's, commission revenue, and then there's contingency bonuses. And then usually what we have to dig into is the other income. And so you guys know better than I do, but I get like a lot in California, we see like fees associated with the policies. And so for us, it's just understanding what's most important to us is that it's true recurring revenue and it's not one time. So we don't have to make an adjustment. And so that's always my first question is, hey, what's the other income of 60,000 you have listed here? And depending on what that is, we can truly count it, or sometimes we have to back it up.
Yeah. It's funny. Like, I had an agency that had a lot of bonds, a ton of bonds. Well, those don't recur in the same way that a car insurance or a commercial insurance policy would. So you have to think about that. And if it's a significant portion of your book, it's going to behave differently. You got to know that. You're 100% right, though. The other income line, the challenge is when it's all folded up together and no one actually looks at that differently, it can seem like a really easy thing to know your revenue. But the reality is what the bank or what the buyer views as recurring revenue might not be that number that looks so easy to pull off of your P&L. And if you're the buyer for the first time and you just take that number times revenue, that revenue number times a multiple because everybody else is doing it, the reality is you could put yourself in a bad situation if that revenue is not all recurring and it's not something that's a solid number, right? I mean, I get all the time. So sometimes people will say, well, can't you just give me a back of the envelope what you think this potential acquisition or agency is worth? And they want me to take that revenue times a number. Right. How do you answer that question?
So, we are not allowed to do the valuations in-house. So after the deal is approved and we move to closing, we have to order an independent third-party valuation. So we would use Agency Focus or, someone like you guys. So, I mean, I'm sure you guys, the number one question you get is about the multiples. And is that right?
Sure.
Yeah. So we get that question all the time. And what's a little tricky is like, we're not allowed to set the purchase price, and we don't, but we lend up to 100% of that valuation amount. So that part actually is similar to buying a house. I mean, whatever the appraisal comes back at is what we're comfortable lending to. That is probably one of the trickiest parts of this job, is someone showing me financials and saying, how is this price? Because like we're really good at finding the EBITDA and the profitability. But when it comes to how solid the book of business is, like how the deep, detailed work that you guys do, we don't quite get into that heavy. And I know, like, I mean, you guys are the experts that a business, two agencies both doing $1 million in revenue, that valuation could be completely different.
100%.
And so it's just being prepared and being honest. I found up front is very important when you have to state like, hey, we need to get a valuation, just so you know, if it comes in light, here's how we treat that. Because I've had some situations where they come in light and then they're not too happy about it.
Yeah, I get it.
But then again, I mean, that comes back to what you said in the beginning. Some of the advice we give is for the protection of our clients, and it's not fun to hear, but sometimes we are the bearer. Same in our position, right? Sometimes we are the bearer of that bad news. But in the end, you'd rather have that bad news up front rather than 5 years later down the line when you can't pay your dad or your mom, or you can't pay the previous agency owner, you can't pay Covington, because that would not be good.
I want to get paid. No, but yeah. And I think that it's always a credit call. But that part is tricky because, there's got to be a renegotiation, or you just bridge the gap with a seller note. Sometimes like the bank will lend up to 100% and then use whatever you're overpaying, we'll put on a seller note. And sometimes that's fine as well.
Yeah, love it. Well, Covington, thanks for spending time with us. I really appreciate it. I think any time we can talk about what things you should be thinking about, how to prepare. I think we're all just doing a huge service to independent agents that are thinking about dipping their toe in the water to acquire, or making sure they have a smooth exit. And you guys have been incredible partners in that. So I appreciate you coming on and sharing your thoughts and helping educate the people that we both serve together. So, and it's great, always great seeing you.
Yeah, well, thank you so much. I did not think that, I just got a business degree in college and then started at Live Oak. Been here for 6 years, and I was underwriting for the insurance team. That's how I got into the industry. Never thought I'd be doing insurance lending, but I absolutely love it. I mean, I've been doing it for 3 years now, and like the people in this industry are just so kind and so nice, just like you guys. And I don't know, it's been great. I mean, this industry, it really is, I think, the most resilient and greatest industry in the world. I mean, it's recurring revenue. It's resilient in economic downturn. Like, I don't ever want to leave. So I'm learning more and more every day, but it's been a lot of fun. I really enjoy it.
Yeah, I agree. Best kept secret, isn't it?
Yeah, exactly.
100%.
Thanks so much for tuning in to the Insurance Refocused podcast. If you enjoyed the episode, please be sure to hit subscribe and leave us a review so you'll never miss us. Want to learn more about how Agency Focus can help you grow your agency? Head to agency-focus.com or email Carey directly at carey@agency-focus.com. If you need to get in touch with me, feel free to shoot me an email at lindsay@agency-focus.com. Thanks so much for tuning in. We'll see you next week.